So how does the new mortgage stress test impact your home purchase? We'll talk about that and how it impacts your ability to afford a home if you're a first-time home buyer. I'll explain the why behind this concept in a way that you may have not thought of before. I'll also leave you with some action items I would consider if I was impacted by this situation. So stay tuned and watch until the end.
Money does not possess me. Money? What is it, money? Somebody gonna have to tell the truth and I'm gonna tell it.
Hey, I'm Hervin Pesa. If we haven't met before, welcome. I'm a fee-for-service financial planner from Calgary, but just like you, I'm still in this journey to building wealth and financial independence, so I'm not approaching this as somebody coming from a high horse. I just post weekly videos diving deep into money lessons we never really learned from school, and oftentimes we're uncomfortable asking our friends and family about it. So if you're ready to take control of your finances and want to join us in this journey as we all learn together, consider subscribing and be sure to hit the bell so you never miss any of our episodes. By the way, we already did a video going over mortgage affordability and the concept behind it. You can watch that over here or the descriptions below. Just make sure you finish this one first. This is an added video to our first-time homebuyer series, and it was requested by a subscriber that goes by the username World of Fun Collections. If you have any questions or video topic requests just like this one, please feel free to leave a comment below or DM me at Instagram at Hervin Pesa. If you like this series or believe in our mission, please show the YouTube algorithm some love and make sure you hit that thumb button until it turns blue. On June 1st of 2021, the regulators have increased the mortgage stress test rate to 5.25%. But what does that mean to you, the first-time homebuyer? Well, first, let's review what the mortgage stress test even is. The mortgage stress test rate is the minimum qualifying rate, as it's formally called, is designed to account for increasing interest rates in the future. The regulators, they want buyers who can afford to buy the homes today, but also maintain the payments in the duration of the mortgage or the loan. But why is that important to you? I'll tell you why. But first, we have to do a bit of a history lesson. Let's do some time traveling.
If you are watching us from the last home you'll ever own tonight, consider yourself lucky. Same goes for anyone ready to buy a slice of the American dream. But if you're among the millions trying to sell, this was a very bad
Since the beginning of the mortgage crisis, 1.5 million Americans lost their homes.
Because there is a second mortgage shock heading for the economy.
It started in real estate, and it started with subprime, and that's the story everyone knows. How does that crisis in the suburbs of America move all the way back to the center of finance?
The 2008 financial disaster known as the Great Recession also goes down in history as the subprime mortgage crisis. Essentially, it was a bunch of bad mortgages, bad loans, being passed off and sold off as repackaged investment-grade securities. See, when you get a mortgage, you are putting the house up as collateral, so the loans were always seen as a safe bet by lenders and investors because you can always get the house if borrowers defaulted or stopped paying their mortgages. Especially because until that point, the belief was housing prices are just gonna keep going up and up and up and up over time, which, looking back, we know is wrong. Lenders then sell these loans as low-risk, income-producing investments known as mortgage-backed securities. When the borrower makes the mortgage payments, the cash flow is redirected to the investor. And the primary investor is typically an investment bank who then buys other debts like car loans and other loans backed by assets, which can also be seized as collateral. This investment bank then repackages all of these, and all of the loans are sold as a financial instrument known as a CDO, or collateralized debt obligation. All of this sounds complex and sounds like a bunch of paper shuffling, but theoretically everything works. And this would have worked if the loans were given to low-risk borrowers with sufficient income and great credit histories, proving that they can actually pay the loans. Unfortunately, this house of cards was not built on that. It was built on a foundation of bad loans, bad mortgages, and even worse business practices. Bad mortgages were being given to good people who were not financially fit to handle these loans. To be clear, the people that were getting loans were not bad. It was bad people that were pursuing poor business practices. Low-income individuals who oftentimes were the first in their family to ever get a home in America were given loans that they didn't really understand. When you buy a home and you get a mortgage, your payment will include a blend of interest and principal payments, until eventually, on your last payment, you owe nothing on the house. However, to make the loans more affordable and enticing, subprime lenders were offering special structures, giving interest-only loans and balloon payment loans that were artificially low for 6 months, a year, 12 months, or even 2 years. Unlike conventional mortgages with balloon payments, the principal is not typically touched until the last payment. If you bought a $500,000 home with your mortgage payment, it would likely be $2,000 every month, but with an interest-only loan, it's closer to $800, making it sound like a great deal, right? The main intention or the reasoning behind this was even if you paid interest only, when you needed to refinance after the first term is up, the home value would have gone up in value, and then you can trade it in and refinance it for a conventional loan. But what if the home is worth less than the loan at that time? Well, that's exactly what happened. As the rates adjusted and the mortgage payments increased and became unaffordable, these people defaulted, walked away from their homes because they just couldn't make the payments. As defaults increased, there was also a sudden glut in homes in the market. More sellers, less buyers, equals pricing going down. So the vicious cycle eventually continued and prices dropped further and further and further until all the losses rolled all the way back up to the investors, the investment banks, and the web of all the confusing securities began to unravel. So why are you telling us this story, Hervs? You mean aside from padding my video and getting more watch hours and flexing my mind muscles? Well, I'll tell you why. Do you know how many banks failed in the States during the Great Recession or immediately after?
Shares are down 90% this morning, and it's not just Bear. Pretty much every single bank is plunging in early trade this morning. Lehman, which is very similar to Bear and its reliance on fixed income, is down nearly 30%.
Could AIG be the next shoe to drop? In the past hour, we had Standard & Poor's and Moody's both cutting their ratings for the insurance giant by a notch.
According to our infallible source, which is Wikipedia, 465 banks closed within 5 years of the financial crisis. Do you know how many banks failed in Canada due to the financial crisis? 0, zip, zilch, nada. I want to show you that. I want to show you that the Canadian banking system is generally more conservative than our southern neighbors. This is partly why we didn't see the same financial crash and same banking crash that riddled them in 2007 to 2008. See, they may have more guns than us, but we have more cheese curds and gravy in our fries, but we also have more banking rules. The housing market in Canada has gone absolutely bananas in 2021. So now the same priority in safety and prudence should be applied more than ever. The market got so hot primarily because of historically low interest rates. But what people didn't predict is there's been a massive shift in buyer preferences. We don't know if that trend's gonna continue, but there's an exodus from shared spaces of condos, and because of the growing acceptance of work from home arrangements, people started buying and considering bigger homes that they wouldn't have otherwise bought last year because they need the extra office space or the extra study room for the kids because everyone's at home. The market is so hot right now because of the rush of buyers. It's so crazy that blind bids became common, bidding wars became an expectation, and naming firstborns after sellers became a buying tactic. I mean, look at how much house you can afford for a bargain basement discounted price of just under $10 million. But that's only in Vancouver, right? Wrong. See, pricing all over BC is up 28.7%. Alberta is up 21.1% year over year, and Saskatchewan is up 10.5% since last year. Manitoba is at 13.6%. Ontario has a staggering increase of 46% year over year. Quebec is up at 32.6%, New Brunswick at 41.3%, Nova Scotia at 39.5%, Prince Edward Island at 43.3%, Newfoundland and Labrador 8.2%, the Yukon 23.1%. Northwest Territories at 3.4%. So it's crazy everywhere, except the Northwest Territories, it seems. As Pierre points out, houses are not cheap. But you know what is cheap? But it's only cheap for today. You can become a proud owner of a blue thumbs up button on one of my videos for free $99. But wait, there's more. If you leave a comment below, we will make sure we send you a link of a very passionate and motivational guy singing a song telling you about a story of triumph and never ever giving up. Na 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 na. Experts are in disagreement. Some say we're in a bubble, some say we're not. With a market this hot, a lot of Canadians are simply being priced out, and this has led many to believe that we are in a housing crisis. There's a lot of people waiting for lawmakers and regulators to step in and help control soaring prices, calling for taxes on investors and non-residents who are often blamed for speculative price movements in the real estate market and the housing market. But whether or not we're in a bubble, OSFI is not waiting to find out. All over the world, governments and regulators, depending on the market, typically have a few tools that they can deploy to impact real estate pricing. Number one is interest rates. Number two is relaxing or tightening mortgage regulations. And number three is tweeting about it. Oh wait, that guy's not here anymore. So let's quickly talk about interest rates. To many economists, interest rates serve as the brake to the economy. Increasing interest rates tend to slow down borrowing, reducing leverage spending, and reducing economic activity in the process. Raising interest rates makes the cost of borrowing more expensive, and it makes everything that requires financing less affordable or less desirable. So why can't the Bank of Canada just increase interest rates? Well, first of all, the mortgage rates, the fixed mortgage rates, are typically more tied to long-term bond rates instead of the overnight rates, which the Bank of Canada controls. And the other thing is, interest rate adjustments are not precision instruments. Think shotgun versus a sniper, or a paintbrush versus a spray can. Interest rates have been eased globally on purpose to stimulate spending after the world seemingly came to a standstill in 2020.
It's known as the crossroads of the world. New York's Times Square, where 50 million people usually visit each year, more than any other destination spot in America. But today, because of the pandemic, it is a virtual ghost town.
Central banks all over the world are keeping interest rates low to stimulate and revive parts of the economy. At least that's the thought behind it, and that's what Canada is doing as well. So increasing interest rates can cool down the pricing in the homes potentially, but it could also do the same thing to other parts of the economy that still needs to get rolling. At least that's the thought behind it. So instead of raising interest rates, regulators can use their powers to make applications for mortgages more stringent. And part of that is increasing the stress test. That's been in place to make borrowing more prudent. And OSFI typically meets in December to set the stress test rates in the coming year. But because of the insane market this year, they've had to do that sooner than later. When finalizing approval, your lender will do a stress tested calculation based on the prescribed rate, or whatever your approved rate was plus 2%, whatever is larger. After June 1st, the new prescribed rate is 5.25%. This is up 46 basis points from the previous 4.79%. Just to be clear, the lender will approve you based on these rates, but it will not actually charge you that. It'll still charge you based on the approved rate that you're gonna receive. So how does that change what a first-time home buyer is gonna be able to buy? When we did the affordability video and we calculated the maximum available loan, the stress test at the time was 4.79%. The maximum loan available was $428,000. We ran the same calculation with the new rate of 5.25%. The new loan maximum shrunk down to $408,000. This is a 4.6% reduction in the price that you can afford or qualify for because of the new prescribed rate. This 5% swing is not insurmountable, but it's definitely gonna lower everyone's buying power. So in theory, this should help cool down the pricing. Whether that's enough or not is still left to be seen. What would I do if I was impacted by this situation? Well, the first thing I would do, honestly, is wait and do nothing. I believe that the current market activity is not sustainable. And if everybody's budget got reduced by 5%, just like I did, maybe the homes that I wanted to buy to begin with would be getting cheaper, or because the competition's also getting reduced, then maybe I'm still gonna end up buying the same place. And if I can't wait, I wanna make sure that my realtor is well aware of the market situation and my current budget change now. I also would rely on them to help me make the right decision, whether I have to look for a smaller home or one that requires a little bit more work because technically my budget got reduced. The third is I would find a way to reduce my debt servicing. I explained that already in the affordability video, so really watch that after this. But before the test rates even apply, approvals are first based on what portion of your income is being spent to buy the house and service the house and pay other loans, cards, and other liabilities. So if I had debts that were only a few $100 before being paid, a few $1,000s before being paid, what I could do is potentially pay those off first so it no longer shows up on my debt servicing calculation, and it would increase what portion of my paycheck can be allocated to the home purchase. That's really all for now. If you have any follow-up questions, please leave us a comment or DM me at Hervin Pesa on Instagram. Don't forget to share this video with others who you believe can get value out of it. We want to help more people, and honestly, as an audacious goal, I want to hit 10,000 subs by January of 2022. So if you find this helpful and you find this meaningful and you want to help us with our mission, please subscribe and share with others so that we can get to our goal. Until next time, stay aware, take control. I love you all. Peace out.